warm welcome to one and all. I'm Dr. Isha Narula, Assistant Professor, Vivekananda Institute of Professional Studies, Technical Campus. Today the topic which we are going to discuss is portfolio restructuring. The topics which we are going to cover today are meaning of portfolio restructuring, causes of portfolio restructuring, types of portfolio restructuring. Now let us understand the meaning of portfolio restructuring. The act of rearranging an investment portfolio's composition to better suit an investor's evolving risk tolerance, financial objectives, market circumstances, or investing methods is known as portfolio restructuring. In order to increase performance, lower risk, or adapt to changing conditions, it entails purchasing, selling, or reallocating assets within the portfolio. The initial design of a portfolio is frequently determined by the goals and risk tolerance of the investor. But over time, things like market swings, modification to one's own financial objective, life events, or changes in the economy may render the initial portfolio less appropriate. For instance, when an investor gets close to retirement, a portfolio that is mostly made up of stocks may become excessively risky, or some asset classes may perform poorly and call for a change. Now let us understand why portfolio restructuring is important. First is risk management. Changing the asset mix to better suit an investor's risk tolerance and the state of the market is known as portfolio restructuring for risk management. This might entail shifting to safer investments like bonds, improving diversification, or decreasing exposure to erratic assets. The objective is to reduce possible losses, maintain returns, and make ensuring the portfolio is still appropriate if financial objectives or outside threats changes. Second is performance improvement. Realigning investments to increase returns in response to shifting market circumstances, asset performance, or financial objectives is known as portfolio restructuring for performance improvement. This might entail moving towards industries like promising development prospects, adding high potential investments, or dumping underperforming assets. Investors may increase the efficiency of their portfolio, boost return potential, and make sure it stays in line with their goals and investing plans by examining performance indicators and market trends. Third is goal alignment. Changing the investment portfolio to reflect an investor's changing financial goal, such as retirement, house ownership, or financial education, is known as portfolio restructuring for goal alignment. The portfolio may need to be reallocated when objectives change over time. For instance, one can get closer to a goal, high-risk assets may need to give way to more stable investments. This guarantees that the portfolio stays time-appropriate, purpose-driven, and in line with the investor's risk tolerance and intended results. Fourth is tax efficiency. Optimizing an investment portfolio to lower tax obligations and increase after-tax returns is the main goal of portfolio restructuring for tax efficiency. This includes tactics like asset placements, which is putting tax-efficient assets in taxable accounts and tax-inefficient assets in tax-advantage accounts such as IRA or 401ks, and tax loss harvesting, which entails selling losing investment to offset capital gains. In order to be eligible for long-term capital gains tax rates, investor might also modify their holding period. Frequent tax-efficient restructuring helps protect more capital, particularly for long-term investors who want to maximize net returns while adhering to tax regulation. Fifth is market adaptation. Restructuring a portfolio to accommodate shifting market trends, geopolitical events, or economic situations is known as market adaptability. Certain industries or asset classes may become more or less appealing as markets change. Investors can raise their investments in new prospects and decrease their exposure to underperforming sectors through restructuring. In addition to capturing fresh growth and protecting the portfolio from downturns, this proactive method keeps the portfolio in line with the investor's risk-return preferences and the state of the market. Now, there are mainly three causes of portfolio restructuring, namely market changes, economic changes, and personal changes. Let's understand how market changes affect portfolios. Restructuring a portfolio as a result of market shifts entails modifying investment holdings in reaction to changing industry trends, interest rates, inflations, and geopolitical events. Certain asset classes or industries may perform better or worse than others due to market fluctuations, necessitating portfolio realignment for improved performance and risk management. For instance, investors may lessen their exposure to bonds in an environment when interest rates are rising. Number 2, portfolios may move towards stocks or cyclical industries during periods of economic expansion. Number 3 is more proactive investments such as gold or utilities may be preferred in erratic markets. The portfolio is kept in line with the market's present prospects and risk thanks to this reorganization. It also aids in risk management, capital preservation, and profit maximization. A crucial component of proactive investment management is routinely assessing and adjusting the portfolio in response to market conditions. Let's understand now economic changes. Economic changes affect portfolios. Restructuring a portfolio because of personal changes entails modifying an investment portfolio to take into account changes in an investor's risk tolerance, financial objectives, or life circumstances. Re-evaluating investing strategies is frequently necessary after major life changes like marriage, birth of a child, retirement, career changes, or unforeseen cost. For instance, a retirement draws near, investors may decide to switch from riskier stocks to safer bonds in order to protect their money. Funding for schooling may become more necessary with the addition of a new kid, leading to investments in long-term growth assets. The asset composition of the portfolio may need to be adjusted due to the shifts in income or risk tolerance. Through many life phases, this type of reorganization guarantees that portfolio stays effective and relevant, supporting the investor's present goals and financial stability. Let's understand how economic changes affect portfolios. Restructuring a portfolio because of economic considerations entails modifying the asset allocation in reaction to shifts in overall state of the economy. Investment success may be greatly impacted by variables such as inflation rates, changes in interest rates, economic expansion or contraction, and monetary or fiscal policies. For instance, investors may increase their exposure to real assets or inflation-projected securities during periods of rising inflation. Bond prices usually decline as interest rates rises, thus it can be required to reduce bond holdings or switch to shorter duration bonds. For stability during a recession, portfolios may lean towards defensive industries like utilities or consumer staples. By modifying the portfolio in response to market conditions, investors may reduce risk, protect their money, and take advantage of new possibilities while maintaining the portfolio's alignment with the macroeconomic environment and their objective. The process might be partial or comprehensive, ranging from minor adjustments to asset weights to a complete overhaul of the investment strategy. Its goal is to maintain the portfolio's longevity and relevance, ensuring that the investment strategy will continue to support long-term financial success. There are mainly 6 types of portfolio restructuring, namely strategic restructuring, tactical restructuring, tax-driven restructuring, risk-based restructuring, performance-driven restructuring, income-driven restructuring. First, let's understand strategic restructuring. A long-term fundamental shift in an investment portfolio's composition to better suit an investor's changing time horizon, risk tolerance, or financial objective is known as strategic restructuring. In contrast to short-term tactical actions, strategic restructuring entails reevaluating the investment strategy and core asset allocation to make sure the portfolio is still suitable in the long run. Let's understand how it operates. For instance, in order to optimize growth, a youthful investor with a high risk tolerance can initially maintain a portfolio that is mostly composed of stocks. For example, 80% stocks, 20% bonds. To lower risk and protect wealth, as people get closer to the retirement, strategic reorganization may move the portfolio towards more conservative assets. For example, 40% equities and 60% bonds. Similarly to this, investors may restructure by changing investment types and time horizon, including boosting exposure to medium-term fixed assets, income, or education saving plans. If their financial objectives change, such as saving for a child's education rather than early retirement. For instance, let's say an investor's first goal is 30% bonds and 70% equities. As the market grew over time, equities today make up 85%. As retirement draws near, they take a more cautious stance by carefully rebalancing their returns to the initial allocation or change it to 60% equity and 40% bonds in order to lower the risk. Through good risk management and pursuit of suitable returns over time, strategic restructuring aids in preserving alignment between the portfolio and individual goals. Long-term financial success requires this proactive, goal-oriented method. Let's understand tactical restructuring. Depending on the state of the market, the prognosis for the economy or potential investments, tactical restructuring entails market short to medium changes to asset allocation of a portfolio. Tactical actions seek to take advantages of market trends or inefficiencies in order to increase profits or temporarily lower risk, in contrast to strategic restructuring, which is more concerned with long-term objectives. Let's understand how it operates. For example, an investor may temporarily boost exposure to cyclical sectors like technology or consumer discretionary, which often outperform in such condition if economic signs point to a robust growth phase ahead. On the other hand, the portfolio may be strategically moved towards defensive industries like utilities or consumer staples in order to protect capital during projected market downturns or recessions. For instance, when the stock market seems cheap, an investor who has strategic allocation of 60% stock and 40% bonds may strategically increase the proportion of stocks to 70% in an effort to improve returns. They could go back to their initial allocation whenever risk increases or market circumstances stabilizes. Now let's understand tax-driven restructuring. The deliberate reorganization of a portfolio to reduce tax obligation and increase post-tax profit is known as tax-driven restructuring. This kind of restructuring, which is particularly crucial in taxable accounts, takes into consideration the tax ramification of purchasing, disposing of, and keeping different investments. Let's understand how it operates. Selling failing assets at a loss to offset capital gains achieved elsewhere in the portfolio is a frequent tactical known as tax loss harvesting. Tax bills may be lowered as a result of this reduction in total taxable income. In order to preserve portfolio exposure without breaking any tax laws, the investor may then reinvest the proceeds into comparable but distinct assets. Asset placement is another tax-driven strategy that involves putting tax-efficient assets such as index funds or low-turnover equities in taxable accounts and tax-inefficient investments such as bonds that provide regular interest in tax-advantaged accounts like IRAs or 401ks. This maximizes tax treatment according to the type of investment. By keeping assets for longer than a year, investors can also take into account when to sell in order to take advantage of reduced long-term capital gain tax rates. For instance, in order to offset capital gains from the sale of one stock and lower the amount of tax due in the next year, an investor may choose to sell another failing stock at a loss. Tax-driven restructuring enhances net returns and supports long-term financial objectives by allowing investors to retain a larger portion of their investment profits. Let's understand risk-based restructuring. The purpose of risk-based restructuring is to adjust a portfolio to better manage or lower risk in accordance with an investor's shifting financial objectives, risk tolerance, or external market conditions. The goal of this kind of reorganization is to reduce the overall volatility and loss risk of the portfolio. Let's understand how it operates. An investor may try to reduce risk by decreasing holdings in volatile assets like stocks and increasing investment in more stable assets like bonds or cash equivalents if the circumstances change, such as when they approach retirement or go through a significant life event. Similarly, risk-based restructuring might move to portfolio towards defensive industries or assets with lower betas, which are less sensitive to market fluctuations during periods of increased market uncertainties or economic downturns. Spreading investments across asset classes, industries, and region is a crucial strategy in this case to reduce the impact of any one investment's underwhelming performance. For instance, to lessen portfolio volatility, an investor who was initially at peace with 70% equity allocation can lower it to 50% and boost bonds or dividend-paying equities. As an alternative, increasing diversity and lowering risk can be achieved by including foreign bonds or real estate investment trust. It benefits by preserving capital and ensuring that the investment strategy stays in line with the investor's comfort level and financial requirement. Risk-based restructuring helps shield the portfolio from significant losses. It is a necessary practice for peace of mind and long-term portfolio resilience. Now let's understand performance-based restructuring. A portfolio based on performance entails selling underperforming assets and redistributing money to more promising or better performing ventures. By consistently refining the asset mix in light of current performance patterns and potential future growth, the objective is to increase total portfolio returns. Let's understand how it operates. In order to find lagging assets or industries that are no longer meeting return expectations, investors routinely assess the performance of their portfolio. The money raised from the sale or reduction of these assets may be put back into venture with higher growth potential or greater risk-adjusted returns. Each type of restructuring serves a specific purpose but often overlaps to keep the portfolio aligned with the investor's changing needs and external factors. For instance, a more promising industry like as technology or healthcare may be substituted for the stock or the sector that often performs worse than the market or the investor's benchmark. On the other hand, assets that exhibit overvaluation but have lately performed well may be cut to lock in profits. Now let's understand income-driven restructuring. Restructuring a portfolio to favor consistent and dependable income generation, usually from interest dividends or rental yields, is known as income-focused restructuring. For investors who require steady cash flows, such as retirees or those looking to augment their monthly income, this approach is particularly crucial. Let's understand how it operates. The portfolio's focus is shifted from capital growth to income-producing assets during the restructuring process. Increasing investments in dividend-paying equities, bonds, real estate investment trusts, and other fixed income instruments may be one way to do this. The objective is to control risk while generating a steady and predictable revenue stream. For instance, an investor who is getting close to retirement may reorganize by shifting their investment away from high growth but erratic equities and toward blue chip firms with steady dividends, corporate or municipal bonds, and income producing REITs. This strikes a compromise between the necessity for income and possibility of modest capital growth. Now let us understand the challenges faced during restructuring. The first one is transaction cost. The transaction expenses associated with purchasing and disposing of assets present a significant obstacle to portfolio restructuring. Brokerage charges, bid aid spreads, and occasionally taxes are among the expenses that are usually associated with every deal. These expenses can mount up fast, particularly if there are frequent restructurings or significant portfolio adjustments. The advantages of reallocating or rebalancing investment may be countered by high transaction cost, which lower total net returns. For instance, trading often to modify asset allocation in response to transient market fluctuations may result in exorbitant cost, which over time may reduce the value of the portfolio. Restructuring may also be more costly or challenging in some markets or asset classes due to increased transaction cost or liquidity restrictions. Second is market timing risk. Market timing risk, which arises when investors try to forecast and respond to short-term market changes, is a major obstacle in portfolio restructuring. Although it may seem idle to try to buy low and sell high, even experienced investors find it very challenging to time the market correctly. Investors may sell assets early or purchase at peak prices if restructuring choices are based on inaccurate market forecast, which might lead to lost profits or actual losses. Portfolio performance might be harmed, for instance, by increasing exposure prior to a downturn or selling equities shortly before the recovery. This danger is increased when markets are volatile because quick fluctuations might cause people to make rash or emotional decisions. Investors are advised to prioritize long-term objectives and stick to methodical, disciplined restructuring techniques over frequent speculative transactions in order to reduce market timing risk. By reducing reliance on market timing, strategic or rule-based rebalancing helps maintain the stability and growth potential of a portfolio. The third point here is behavioral biases. Behavioral biases can seriously impair portfolio restructuring's efficacy. These psychological inclinations encourage investors to make emotionally motivated or illogical judgments, which frequently have negative consequences. A major contributing factor to the complexity of portfolio restructuring is behavioral biases. Even when restructuring is required to enhance performance or control risk, investors who are prone to loss aversion refrain from selling underperforming assets in the hopes that they would rebound. People that are overconfident tend to depend too much on their own market forecasts, which frequently leads to excessive trading or too aggressive reallocation, which raises risk and expenses. Rather than keeping a long-term view in line with financial objectives, recency bias tempts investors to base decisions on current market patterns, such as reallocating into industries that have recently done well. Last but not the least, herd mentality encourages people to follow trends in the market, which may lead them to purchase or sell assets that are not appropriate for their individual requirement or risk tolerance. These prejudices may impede prompt and logical reorganization, which would eventually impair portfolio performance and alignment with individual goals. Effective and disciplined investment management requires an awareness of the commitment to reducing these biases. Fourth is complexity. Because portfolio restructuring requires in-depth research, strategic decision-making, and ongoing monitoring, complexity is a major barrier. A number of considerations need to be considered by investors, including risk levels, market circumstances, tax consequences, asset performance, and financial objectives. A solid grasp of financial planning and investing principle is necessary to strike a balance between these factors. The complexity is further increased by taking into account worldwide markets, a variety of asset types, and evolving rules. Without expert guidance, navigating this complexity as an individual investor may result in mistakes, lost opportunities, or mismatched allocation. Effective portfolio restructuring therefore requires knowledge, self-control, and patience, qualities that not all investors may have. Point number 5 is tax implication. Because capital gain taxes might be triggered by the purchase or sale of investment, tax consideration provide a significant difficulty when restructuring a portfolio. Depending on the holding period, realized gains for the sale of the assets that result in profit may be liable to either short-term or long-term capital gain tax. The net advantage of restructuring may be much diminished as a result. Frequent trading may also result in more taxable events, raising the investor's total tax obligation. Without proper planning, the benefits of realignment can also be outweighed by the tax ramification. In order to reduce tax costs, restructuring must be handled systematically and with tax-efficient techniques like tax loss harvesting or time sales. Effective portfolio restructuring balances these benefits and challenges, requiring careful planning, discipline, and a clear understanding of the investor goals and market conditions. Thank you so much everyone for your patient listening. We will discuss more topics in coming classes. Thank you so much.